Charts are essential to technical analysis as they provide the foundation to the entire study. They are the means to view how price is moving in a visual way. Charts allow a trader to track how price is moving and will form in the backdrop in which traders can place various indicators to help them make decisions on how price may move in the future. Charts can be set up to show different time frames and in many different visual styles to track how the price of an underlying instrument is moving. Depending on your time horizon for trades, a trader will choose to look at various charts showing various time frames. A longer-term trader may track price on a weekly or monthly chart, while a shorter-term trader may use charts with a 60-minute or 5-minute chart. There are many ways to organize charts and many ways to organize the visual representation of price on these charts. The most common chart types are candlestick, bar charts, and line charts. Regardless of which type of visual representation of price traders use, candlesticks, bar charts, and line charts help to find clues to identify whether the market is trending, reversal signals at market tops and bottoms, and/or identify periods of consolidation. Candlestick charts use a representation of price called a candlestick. There are two components to each candle, the body and the wick. The wick or thin line shows the highest and lowest prices traded over the time frame. The body of the candle shows the open and closing prices of the time frame. If the close is higher than the open, then the color of the bar will generally be green, depending on the color setting of your software. And if the closing price is lower than the opening price, then the bar will generally be red in color, depending on the color setting of your software. For example, this 5-minute chart in the ES E-mini S&P 500, the last candle is green and shows that the open of the bar is higher than the close of the last candle. Candlesticks allow traders to visualize buying and selling pressure in two ways. First, the size of the body indicates the intensity of buying or selling. The longer the body, the more price moved either up or down over the period of that candlestick. A short body means that the opening and closing prices were very similar, meaning that there was not much strength to price action. Secondly, the size of the wick relative to the body is important. A candle with a short or no wick means that price action was strong into the close, and either buyers, represented with a green candlestick, or sellers, represented as a red candlestick, were in control for the entire period. If the wicks are long, then there was a large range of prices traded, and buyers and sellers were both in control. Candlesticks can also show you who was in control at the close of the bar. If you have a small body near the low of the bar, it means that at the end of the bar, sellers had taken control from the buyers, who were strong at the open of the bar. If you have a small body near the top of the bar, it means that buyers took control from sellers at the end of the period. Gapping is another signal that traders will look for. Candles that gap above or below the previous candle are an indication that there is a momentum in the trend. For example, the ZB 30-year Treasury note contract gapped down twice in this daily chart and continued to push down after the gap. The line chart is another way to visualize the price of the underlying, but unlike candlesticks, which allows a trader to analyze finer points of pricing, a line chart provides a quick way to visualize a longer-term trend. A line chart is exactly that, a line that represents where price has been in the past. The line chart shows the closing price of a certain time. The bar chart, or OHLC chart, is much like a candlestick chart, but has a few visual differences. Much like a candlestick chart, it provides 4 pieces of data for each period. The opening price is indicated by a small horizontal line to the left, and the closing price to the right. Highs and lows are indicated by the vertical line. Charting patterns and price information from the open, high, low, and close can be observed from both candlesticks and bar charts. As a trader, you will need to set how often a new candlestick or bar appears on your chart using either a time-based approach or trade-based approach. A time-based approach is probably the most familiar to traders. Time-based charts generate a new bar or line point after a set amount of time has passed. Depending on the trader, this can be anywhere from 1 minute to a weekly or yearly chart. Traders who want to use a trade-based approach will use what is commonly referred to as a tick chart. A tick chart generates a new bar or line point after a certain number of trades have occurred. A trader may want a new bar every 25 trades, or might want a new bar after 512 trades. Using time-based or trade-based charts offer the trader different insights into price action. Tick charts will generate new bars faster during time of high volume and more slowly during times of low volume. The speed of new bars being formed may allow a trader to better visualize increasing and decreasing volume in a market. Charts, in combination with other data, can help guide a trader's opinion on where the price of a stock is moving. With the ability to tailor the data points to many specifications, traders can fine-tune their charts to illustrate the information that works best for them.